I think there are still... So welcome back, and I hope you had time to network, to catch up, to follow up on this morning's discussion over lunch, because that's also what these events are for. The networking part is a very important one. So it's my pleasure to resume our discussion and to kick off this afternoon by hearing a presentation about the impact of the tax systems on strengthening competitiveness and fairness. And to do so, I'd like to welcome our keynote speaker for this afternoon. Please welcome Mathias Cormann, Secretary General of the OECD. Good afternoon.
Well, thank you very much, distinguished guests, colleagues, friends all, and thank you so much to all of you for having made it to the after-lunch speaking slot. And let me say thank you very much to the European Commission and the European Parliament for inviting me to share a few observations with you today about the role of effective tax systems in strengthening competitiveness and fairness in Europe and beyond. As several of today's speakers have already emphasized, but it's always good to remind ourselves right up front. Governments need to raise taxes to fund the essential public services the public need and expect. Those taxes should be raised in a way that is efficient, growth-friendly, that is least distorting in the economy, and in a way that is and is seen to be fair and equitable. A well-designed, efficient and fair tax system is indeed fundamental to facilitating strong, sustainable and inclusive growth. And it is essential to ensuring governments can provide essential public services while maintaining competitiveness and economic dynamism. Fairness and equity are fundamental to ensuring sustained public support, as is the need to ensure that the expenditures funded through our tax systems are well targeted, efficient and effective. At this time, countries and jurisdictions all around the world, including and in particular in Europe, are facing a complex and challenging fiscal landscape. The ongoing and lingering fiscal impact of the necessary measures to support the economy during the COVID-19 pandemic, in the context and in the wake of Russia's war of aggression against Ukraine, and in the context and in the wake of high levels of inflation that followed and which have caused public debt to rise sharply. In parallel, debt servicing costs have risen with higher interest rates. European governments need to manage the burden of these costs while also addressing pressing structural pressures and investment needs. To respond to the economic, social and fiscal impacts of population ageing and the associated demands on pension, health and care systems. To make well-targeted investments in the foundational conditions for growth, such as improved infrastructure and support for innovation. To finance higher defence spending, to expand digital connectivity and skills, to enhance energy security and sustainability, and to make further progress on the green transition, including supporting the transition for households and workers that may be, at least initially, adversely affected. Governments cannot manage these pressures without a fully effective and efficient tax system which provides the much-needed revenue to fund those public responsibilities while supporting strong, resilient, sustainable and inclusive growth. So the overarching domestic tax policy priorities we see for the years ahead include, first, enhancing tax policy's contribution to investment and growth. Taxes should be designed to minimize distortions and not discourage productive activities like work, investment or innovation. The broadest possible tax base with lower rates is generally more efficient and effective than a system with many exemptions and loopholes. Consumption taxes and land taxes tend to be less distortionary than taxes on income or capital. Tax policies and administration in the EU need to provide a fully supportive environment for entrepreneurs and productive business investments in innovation and human capital. At the OECD, we gather and we present the evidence on the experiences of countries and jurisdictions around the world, which shows that low-rate, broad-based tax systems are key. These systems can be complemented with well-targeted tax incentives for research and development, which 23 of the 27 EU countries have already introduced and which can be further strengthened. Second, ensuring that tax systems encourage and support employment. This means coordinated and coherent tax and pension reforms to address disincentives for older workers to remain in the workforce. It means tackling the second earner tax wedge, which alongside better childcare coverage can enhance women's labour market participation. And more broadly, it means lowering excessive tax burdens on low-income workers that may discourage full-time work or additional hours of work. So reform and appropriate reforms of the tax and transfer system is fundamentally important in that regard. And progressive taxation, of course, ensures that those with higher incomes appropriately contribute a larger share. Third, strengthening the fairness of and public trust in our tax systems. The fairness of domestic tax systems requires broad tax bases that limit the opportunities for sophisticated taxpayers to take advantage of loopholes to minimise tax liabilities. Towards this, there is significant scope in the European Union to broaden and better assess the tax base, including by strengthening the reporting and the analysis of tax expenditures and effective tax rates. And tax systems should be as simple and as easy as possible to understand, to administer and to comply with, to reduce costs for both taxpayers and governments. Complexity leads to inefficiency, to loopholes, to higher compliance costs. Tax policies should also be as predictable as possible so businesses and individuals can plan for the future. These domestic policy priorities must be accompanied by effective international tax cooperation to avoid double taxation and to avoid low or no taxation. International tax cooperation remains essential for the EU and indeed all countries around the world to meet spending needs, to protect their sovereignty and to ensure a strong foundation for fiscal sustainability and growth. If done the right way, it provides businesses with the policy certainty they need to make investments, to compete globally and to pursue new opportunities. It ensures stability by enabling mutually beneficial solutions to the tax challenges that arise from cross-border business and digitalisation, while alleviating the need for counterproductive unilateral measures, fostering growth and dynamism in our economies. International tax cooperation is about preventing double taxation, avoiding wasteful administrative costs for businesses and governments, and reducing investment uncertainty, or saying it more positively, maximising investment certainty. Governments around the world have recognised the benefits of international tax cooperation, and at the OECD we have long been supporting countries in advancing their fiscal goals. The 1963 Model Tax Convention and the OECD Transfer Pricing Guidelines, first adopted in 1995, provide key frameworks for the avoidance of double taxation and the prevention of tax evasion. Our work to facilitate cooperation on tax transparency and exchange of information for tax purposes put an end to bank secrecy and reduced tax collection gaps. The launch of the Base Erosion and Profit Shifting Project in 2015 modernised existing international rules and standards to adapt to changing business models to address tax avoidance strategies that exploited gaps and mismatches in tax rules. And finally, the expansion of our data sets and analysis has helped strengthen our capacity to provide reliable, evidence-based advice to help inform domestic tax reforms. The European Union has been a very strong partner in these efforts, including through the adoption of the base erosion and profit shifting measures into the Anti-Tax Avoidance Directive and the Common Reporting Standard into the Directive on Administrative Cooperation. These achievements in international tax cooperation laid the foundations for a more equitable and efficient global tax system. For instance, thanks to effective exchange of information, more than 130 billion euros of additional revenues have been identified since 2009 on the back of voluntary disclosure programs and offshore tax investigations. The two-pillar solution is just the latest initiative among these long-standing and enduring efforts spanning decades. It is motivated by the same principles that have guided all of our efforts as facilitators of tax cooperation to date: removing barriers to cross-border investment and trade, securing tax certainty and stability, and fostering sustainable economic growth and the opportunities that come with that for all. We have made good progress towards advancing the two pillars, progress that provides a strong foundation for reinforcing and further advancing mutually beneficial tax cooperation. And in this context, I would like to thank the European Union for its leadership and for its strong and consistent engagement on the two-pillar solution. The current focus on our work together, the OECD and the European Union, is on further simplification, including the active exploration of additional simplifications and safe harbours. We are working with the EU and other members to support coordinated and consistent implementation amongst the countries that have adopted the rules so far. And as Commissioner Hoekstra said earlier today, effective tax administration is indeed critical in that regard. We are facilitating ongoing work to reduce complexity and facilitate tax administration in the interest of taxpayers and tax administrations. And we are very grateful to the Netherlands, who have helped launch this work around the Amsterdam dialogue in support of these objectives. But I'm sure that you are all waiting for a further update in relation to the two pillars. So let me focus on an update in relation to the two pillars. Firstly, on Pillar 1, in relation to the reallocation of taxing rights. The co-chairs of the Inclusive Framework on Base Erosion and Profit Shifting published an update on progress at the end of last year. They confirmed the broad consensus on the text of a multilateral convention on Pillar 1 with an agreed approach to the taxation of the largest and most profitable multinationals. The co-chairs reaffirmed the Inclusive Framework's commitment to continue with their best efforts to complete this work, and at the OECD we will continue to engage with all parties to help find the best possible way forward on Pillar 1. Reaching agreement on Pillar 1 would go a long way towards enhancing international tax certainty and stability. Supporting the effective and stable implementation of the global minimum tax under Pillar 2 also remains a top priority. To date, 67 jurisdictions around the world have enacted or are taking concrete steps towards enacting legislation to implement the global minimum tax under Pillar 2. The OECD is committed to ensuring the long-term sustainability of this key achievement in international tax cooperation. We remain in very constructive engagement with all members of the Inclusive Framework, including the European Union and the United States. Last week I was in Washington, where I met with US Treasury Secretary Scott Bessent to listen to the concerns of the United States about the Inclusive Framework negotiated global minimum tax and the US's own global minimum tax, the so-called GILTI regime. And I met with business community representatives who highlighted the importance of continued global cooperation on international tax. Based on my conversations in Washington last week with Secretary Bessent and other interlocutors. I'm quietly confident that there is scope for a pragmatic and constructive resolution of the issues at hand. From the OECD point of view, we will certainly continue to engage in all the necessary discussions with a positive, constructive and pragmatic attitude, facilitating engagement among all inclusive framework members to build and to finalise a fair and sustainable consensus to preserve the gains that have been made and ultimately to secure certainty and stability on a lasting, mutually beneficial and fair and equitable deal. Beyond the specific context of the two pillars, we cannot afford to lose sight of our broader goal, which is to advance international tax cooperation for the benefit of both countries and taxpayers. The EU's continuing active engagement as a strong, constructive partner will be critical. The good news is that there are many opportunities to continue to take international tax cooperation forward. On addressing administrative burdens, we need to work together to identify and address duplicative tax rules to help reduce uncertainty and complexity and ultimately foster business investment and growth. On digitalising tax administrations to make them more efficient, transparent and accessible to taxpayers. Staff training, sound procurement strategies and effective safeguards can help tax administrations draw on the massive potential of technology to streamline tax processes and improve taxpayer services. For example, the use of AI and data analytics can help tax authorities identify and address tax evasion more effectively. The OECD's Forum on Tax Administration is working with member countries to develop best practices and guidelines for the digitalisation of tax administrations in that context. On enhancing tax certainty, the OECD is working to help enhance the business environment by supporting early tax certainty and minimising international tax disputes. This includes improving dispute resolution mechanisms and promoting mutual agreement procedures. The OECD's International Compliance Assurance Programme is an innovative initiative that aims to provide multinational enterprises with greater tax certainty through a cooperative risk assessment and assurance process. On enhancing tax transparency, addressing new challenges to transparency, such as those arising from crypto assets, will be critical. The OECD's crypto asset reporting framework is designed to help combat tax evasion by requiring the reporting of crypto asset transactions to tax authorities. The EU's early adoption of the 8th Directive on Administrative Cooperation is a key step towards improving tax transparency, placing the EU at the forefront of addressing tax evasion in the crypto asset sector. On ensuring policymakers have access to a sound evidence base for tax policy decisions. The OECD's Global Revenue Statistics database, our tax policy reform publication and our effective corporate tax rates are valuable resources for policymakers, providing comprehensive data and analysis on tax systems and policies across OECD member countries and beyond. Finally, on providing support for developing countries to participate in and benefit from the OECD's work on domestic resource mobilisation. The EU and its member states have been strong supporters of the OECD's capacity building efforts through both the Global Forum on Transparency and Exchange of Information for Tax Purposes and the Inclusive Framework on Base Erosion and Profit Shifting. Last year, we also marked the 10th anniversary of the OECD International Academy for Tax and Financial Crime Investigation, hosted by Italy. The Academy has become a major pillar in the global fight against tax and financial crimes, having trained 3,250 government officials from more than 170 jurisdictions to date, equipping them with the skills and investigative techniques to combat tax and financial crimes more effectively. And these efforts complement our highly successful joint OECD-UNDP Tax Inspectors Without Borders initiative, which helps developing countries improve the quality and consistency of tax audits through capacity building for local officials. In closing, effective international tax cooperation is a powerful pro-growth policy fostering both competitiveness and fairness. Supporting this cooperation on the basis of inclusive dialogue is very much in the OECD's DNA. We will continue to work very, very closely with the European Union and with our partners around the world as an objective source of data and analysis, as a platform for mutually beneficial multilateral dialogue to help advance effective solutions to our shared tax policy challenges and ultimately to make our economies a stronger, more sustainable and more inclusive engine for growth and opportunity. Thank you very much.
Thank you. Thank you very much, Mr. Cormann. The time has now come to open our third panel discussion for today, and we will discuss the next steps that we should be taking in relation to European and international tax, corporate tax reform. To do so, I'd like to invite the panelists to join us on stage, and I will hand over the moderation to Susana Ruiz, Tax Policy Lead at Oxfam International.
Thanks very much, and thanks very much for the European Commission and the Parliament for organizing this panel and having such a group of very distinguished speakers today. And this panel on strengthening and competitiveness and fairness to build prosperity on corporate taxation, speaking just after Mathias Cormann, I think it's in the terms of the debate about what we can do and what is the direction of the corporate taxation reform. I think he's mentioning this pragmatic approach on conversation with the US Treasury. I'm pretty sure that many of us would like to hear more about what is that and what direction is going to be in the future. Let me first introduce the panel. Roberta Poza, she is a partner at Deloitte in Spain, and she's a leader on EU tax policies. Tommaso Faccio, who is the head of Secretariat ICRICT, which is the Independent Commission of the Reform of International Corporate Taxation. Gabriel Zuckman is a member of the Commission. Vitor Gaspar, who's the head of IMF Fiscal Affairs Department, and Liselott Kana, who's the co-chair of the UN group of experts on international tax cooperation. So we have a very international panel also, a very diverse, and I think that's going to help also to bridge some of the questions on how to bring this conversation of corporate taxation. Before we start on the question for the panel, I think we need to remind us that as the Commissioner Hoekstra was saying this morning, and Mathias Cormann was mentioning, we're talking about corporate taxation at a moment also where lots of geopolitical trade discussions, we cannot ignore that, but also at the moment when corporations have been, multinational corporations have been those who have been profiting more from globalization. And globalization has been setting also the condition, the needs for reforming the international corporate tax system at international level. But maybe there is still a lot to go into the direction of the reforms that are necessary to make sure that those multinationals are not only profiting from globalization, but contributing to the scale. And it's also a moment when we see that market concentration and the power of some multinationals is setting also the conditions. They are accessing to market, to some of the markets, but they are also imposing some of the conditions. And we've seen that the profits they have been making, I mean, this market concentration is helping in terms of a massive profit level, but we don't see that the level of contribution, tax contribution from those, some of those who have the biggest market concentration have been to the scale also of the profits. And the last thing is to mention also that in some sectors like the energy, the banking sector, the financial sector, and the digital, some of those companies have been doing also, have been experiencing record level profits. But again, the corporate taxes they are paying is probably not on the scale, so something is still not working well. And that's what I expect we will be talking about in the panel. Just to mention that this idea, the element of fairness in the framing of the panel is quite important. We cannot forget that we are at a moment also of where the European Union is challenging to provide additional revenues to respond to the different crises, climate, social, gender crisis. And at the moment also we will still see that many of those corporate profits are still recorded in tax haven, which makes that the fairness within the countries but also between countries is a challenge for and the perception for civil society is quite important in this sense. So, with that, dear panel, let's start with a quick round of responses from your side on what should be the priorities on tax cooperation, on taxation of corporations. What do you think should be the key priorities, and what should be the recommendations? Vitor, can we start with you?
Of course. So I will go very high level in the first round. The theme of this conference is very timely, as usual. We have a situation where, as we've heard already, growth is disappointingly low. In Europe, there are concerns about competitiveness. Levels of debt are high, and there are concerns about public finances. At the same time, there are slow-moving trends like demographics, the energy transition, technological change that are putting additional pressures on public finances. And there are also pressing concerns that come from defense and security. What Europe needs is to have a tax system that can deliver the necessary revenue to finance all of these expenses, while at the same time strengthening growth, competitiveness, and fairness. It's very appropriate that I speak immediately after Mathias Cormann, because I want to make the point that in the immediate future, the priority is to preserve and reinforce, if possible, the machinery of global tax cooperation, and in particular the important achievements in international corporate taxation made possible by the OECD-led inclusive framework. You heard from Mathias how important a partner the EU has been and how engaged the OECD is with all partners in the rest of the world, including the United States. I will be telegraphic with three further messages. In earlier symposia, I have argued that the EU has been a major, or Europe better said, a major innovation in the area of taxation. Going forward, the challenges that we're facing suggest that that power of innovation in what concerns the tax system will be necessary. Secondly, given how much collective action is necessary at European level, in the long run, the ability of the European Union to develop its own tax capacity is likely to become a important area of debate. Last but not least, where should we start from? And indeed there, Susana, my conclusion is that one should precisely start from international corporate taxation.
Thank you, Vitor. International tax cooperation and the need to strengthen that, I think, is going to come very often in the panel. Roberta.
Thank you. Thank you, Susana, and thank you for the Commission and the Parliament for inviting me, and good afternoon, everyone. So I think we have been talking about competitiveness during the whole session, and this is probably where we should focus on. We have seen Draghi, we have seen Greta. Both reports made a quite hard analysis of the situation and the loss of competitiveness in Europe. So we must take it seriously. And if we go to the tax agenda, probably what we need to be able to achieve is a taxation that is being able to promote growth and also fulfillment with the EU agenda. We have an ambitious EU agenda in terms of decarbonization, of innovation, and also, of course, simplification and reduction of the administrative burden. But if we want to talk seriously about simplification, we must start with Pillar 2. Pillar 2 is a huge burden for both companies under the scope and also for the tax administrations that are going to assess the companies under Pillar 2. Also, we have, before it was the Commissioner who mentioned the Clean Industry ID, that we provide incentives, and he said that the state aid, the competition regulation is going to be modified to make it more flexible. But Pillar 2 is also a strong limitation to incentives. So maintaining the rules, because we have to accept that that the rules are useful, especially probably in a highly integrated economic area as the EU, but there are things to modify, and we must address this if we want tax policy to be coherent with the EU agenda and not to hamper the EU agenda. And probably the other aspect is fragmentation. Fragmentation, it was mentioned before. It was even someone saying that it's difficult to model. There are many taxes, many levies. Now you are referring, Susana, to the taxes on banks or energy. But if you look, it's even difficult to know what are the taxes in every country, in every member state. If you go to the banks, they are subject to increased corporate income tax, non-recoverable VAT, taxes on deposits, taxes on financial activity, with profit taxes, insurance premium taxes. So it's a whole amount of taxes that it's fragmented, and those are barriers to internal market. But it is the same for the energy sector. We want incentives, but we're imposing taxes on energy or for some others. So simplification, reduction of fragmentation, and a tax policy aligned with the EU objectives.
Thanks, Roberta. Tommaso, what are your views?
I think we heard in the previous session how the EU has been a force for good, a force for change in international tax cooperation, and with the latest milestone being the Pillar 2, the directive of a minimum tax, a principle that as ICRICT we have been advocating for, and there's now a reality, not just in the EU, but in more than 50 countries. What we've seen, though, is that there's also a new world, a fragmented new world with new alliances being built. And this takes me to a new process, which is the UN Framework Convention process for international tax cooperation. Now, I was quite surprised by this process not being mentioned by both Mathias Cormann and Oxfam in the first session, because it's a process where all the countries in the world are participating, including the EU. So now this process is led by Africa, has been led by Africa. Africa has participated in the inclusive framework, but not broadly out for the countries in Africa. And this is a process which provides an opportunity to have, for the first time, universal standards agreed by all countries in the world, and to build on the strengths and limitation of the two-pillar solution. Nobody is saying we're going to start from scratch. Nobody is saying this is duplicating work. And I do understand that there is the denial that there is within the European Union about this process. They initially opposed the process. Now they broadly starting to think about constructively engaging. And I think it's important to understand in this new world we have the need to build multilateralism, engage with the process, any process. We are working with countries not just on tax, but on trade, on fighting climate change, fighting different crises. It's important that the EU opens up and sees that on one hand, they can choose to side with the US, who walked down the process on day one, or they can engage and cooperate and unite with the rest of the world, because ultimately it is in the interest of the EU to have standards that are not just accepted, but also sustainable long term. And it's only through a legitimate process where all countries participate that give us the best chance to deliver those standards.
Thanks, Tommaso. Maybe Liselott will bring this UN angle to the conversation more.
Thank you, Susana. Well, I thought when I heard Tommaso, perhaps I should sort of explain a little bit the different groups within the UN, because I'm invited here today as the co-chair of the UN Tax Committee. And that tax committee is 25 members that are nominated by the governments, but they act in personal capacity. So when we are doing things, we have our names and not countries in front of us. What Tommaso was mentioning was the new framework convention negotiation at the UN, and that is held under the auspices of the General Assembly. And there, of course, we are political delegates who are acting in capacities of our countries and our governments. Now, the UN Tax Committee, who I'm sort of co-chairing, we have 4 years of membership, and then it rotates, and the Secretariat of the UN gives the new membership to work for 4 years, and it's very sui generis. It's a group that can decide exactly what they want to do. So it's very free in that sense, and much more up to date, so to speak, because the members of the UN Tax Committee can actually decide immediately if they want to look at something. Now, I declare I don't know very much of what's going on in the EU, but what I've heard from today, and it sort of struck me, is that most of us who work in government, in finance, etc., we focus on policy. However, here it's been stressed today, the simplification and reducing tax compliance costs, which are sort of more coordination. It's really something that you can actually work cross-border with every country in the world on. So when you say that you want to make the single market a better market, reducing the compliance cost, etc., I would say that is something that we should do cross-border internationally with everyone who can take part in that. Thank you.
Thank you, Liselott. Vitor.
Thanks, Susana. I would actually like to react very quickly to my fellow panelists. I would start with you, Liselott. You emphasized the importance of tax administration and to be very practical and pragmatic when it comes to international, global cooperation. You spoke about the experience of the United Nations. All of that is very important. Your comment reminded me that one should think about the tax system as bringing together tax policy, you referred to it, but revenue administration, so the tax administration, the way the policy is actually implemented by the administration, and the legal system. That's what the tax system is about. That's what determines how it works in practice. Tommaso, you emphasized, so did you, the importance of multilateralism in general and in these times in particular. And I do think it's very important, the punchline that you gave, which is that it is in the best interest of the European Union to support multilateralism, to support global standards. I do believe that that is true. And Roberta, you emphasized very much the importance of Pillar 2, and I have no disagreement with you on that, but I would want to emphasize the importance of Pillar 1. When it comes to Pillar 1, I believe it's a very innovative approach because it sets a global approach to a tax base, and then it allocates rights to that tax base in accordance with an agreed formula. This from the viewpoint of the degree of cooperation, the degree of integration of a global tax system is quite something else. In an earlier version of this symposium, I called it revolutionary, and I still believe that it does have revolutionary possibilities. Apologies for taking so long.
No, thanks very much, Vitor. And I don't know, Tommaso, if you want to react on this message from Vitor on the revolutionary of the Pillar 1, because revolutionary in theory is one thing, in practice is completely different. So maybe you want to quickly react on.
I was happy that Vitor didn't conclude his remark with a but. I disagree with you. So I agree with probably everything I said, which is a good starting point. On Pillar 1, I think we agree. The principles are great, and this is something as a Commission we're advocating for a number of years, the principle of unity taxation, looking at multinational as a single entity and finding a rough measure, a formula to allocate those profits across each country so there is a fair measure. The EU has been trying to do this since 2011. It feels a bit like Groundhog Day that we're here again, and Vitor is here again after last year. We're still talking about this, and so one hope is that you start as a CCCTB, Common Consolidated Corporate Tax Base, and now as a much more exciting acronym, BFIT. So a lot of people hope that this can be moved forward. And maybe this moment of crisis is one that a lot of things can be moved forward because we can't just stop and be restrained by some of the things that slow down the European Union process, such as the unanimity process. So yes, in principle it's great, but the reality is that two things. One, it only applies to under 200 companies. So what it will generate is a pittance. For countries like France that collect the DSTs today, it might generate less money than it does with the current digital service tax. The other point is political, and it's great that Mathias Cormann keeps repeating that we're so close to the deal with the US, but that was the same discussion that we had when Trump left office in the first time round, when then Yellen came back with a proposal for a Pillar 1, and the same discussion we had last year. But the reality is that it was very difficult under the previous administration, because to work Pillar 1 requires 2/3 of the US Senate to approve it. And the reality is that the numbers were not there last year. It is expected, the US administration believes that this will generate a loss for the US. So we are asking Trump to give us revenue. And we think that the Senate will pass that legislation. I think to me is highly unlikely. So yes, the principles are good, but we should do it on a much broader scale, like BFIT, like the CCTB. But the chances of Pillar 1 ever coming into force are, in my view, close to zero.
So close, but still not there. Roberta.
Briefly, Susana. Well, first, on Pillar 1, I agree with you. It's not going to happen. The US is not going to adopt it because it's not only the administration, but also the Senate, so it's quite difficult. But even if it was adopted, I think in Pillar 1, the theory is nicer than the practice. Because if we look at the reality of the companies under the scope of Pillar 1, for instance, if I look at the companies in Spain, it varies a bit depending on the year. But the only company that is for sure going to be caught under Pillar 1 is a company in the energy sector, so an utility company that has no chance of delocalizing the revenues. Are we serious when we say that this is the way to solve the problems of digitalization? I really think that's not the solution. It was at the beginning, we started distinguishing different sectors, but now it's not the case. And if it is adopted, it will be another layer of complexity and an additional burden.
Liselott.
Well, I think it's about 3 years ago since I heard BIAC's president, Christian Kaiser, at the IFA panel in Berlin, who said that there's zero possibility to have Pillar 1 in force. So we've had sort of time to think about this, that there could be other options, because I do agree with Vitor that, the Pillar 1 is absolutely, technically, the perfect way forward. But if it's not going to be implemented, then it's it's not going anywhere. So you can't, you have a perfect product, but it's not going to be used. So I would like to mention that the UN Tax Committee, actually in its Model 2021, already had an article for digital service taxes. Then you have to switch and you have to say that there's not an excise tax or whatever you're trying to say the type of tax it is, but it has to be declared as an income tax, which might be difficult for some countries, but that could be a way forward, because then you can actually include it in your double tax treaties. And you can apply a withholding tax on it, so that you would actually comply with your treaty obligations by actually including it in your negotiations and actually applying the rate that you're applying as a withholding tax with the GSTs actually. So there is a solution, and just to add to that, that was done in the previous membership of the UN Tax Committee. This tax committee, where I'm now co-chairing, we have implemented, or we've drafted a fast-track instrument, which is very much like the MLI, but it's a living document. You can add protocols to it, so that if you are a group of countries who want to agree on a DST between yourselves, you can actually sign up to this multilateral convention that's going to be presented to ECOSOC at the UN, and you can actually then get credits in your treaties for DSTs. Thank you.
Thanks, Liselott. Vitor, Roberta was talking about how the corporate taxation is experiencing this fragmentation and the need to simplify, but at the IMF, your department, the Fiscal Affairs Department, is even calling for a rethinking of the corporate taxation, even talking about the need to address excess profit tax, which in fact was building also from a reflection on the Pillar 1 also. With the mic, it's better.
Without a mic, this is not going to work well. I want to emphasize that at this point in time, by far, my first priority is to make the current machinery of international cooperation work, and there the most impressive achievement that has been happening in the last years is the success with the international corporate tax agreement under the OECD inclusive framework. But Gerasim's vision for this conference is that we don't focus only on the first priority for the immediate future. We think freely about what might happen in a longer time frame. So I'm not making this comment for today. I'm not making this comment for the next couple of years, but there are issues which are worth thinking about. One of those has to do with the fact that the corporate income tax, even with recent changes in Europe, still has a number of important distortions associated with this. So it's not only about tax rates, it's not only about how broad the tax base is how you design it. And among the distortions that one could list, one has the possibility of the corporate tax rate under the current rules raising the cost of capital. That was a topic that was covered quite exhaustively this morning. But then there is also the important issue of the current system distorting the mix of assets between, say, tangible and intangible capital. And then distortions of investment across sectors according to the characteristics of those sectors. Something that we emphasize very much, and my friend and co-author Ruud de Moy has work on that, is the bias in the financing mix that favors debt over equity, with far-reaching consequences for the functioning and stability of the financial system. And last but not least, and also very much covered this morning, the tax structure does influence the way businesses are organized and run. Now, these distortions reduce economic efficiency and come at the expense of equity and economic growth. That means that rethinking corporate taxation could be a priority for the reform of taxation in the EU going forward. Now, in order to make it neutral, the tax system, a possible candidate would be a cash flow tax. If one would have a destination-based cash flow tax, one would inherit a number of the neutrality properties of the value-added tax together with some of the robust properties of the value-added tax in an international setup. So that's one possibility that does seem to us practical. It's not only a theoretical possibility, it seems to us practicable, and it's probably a best way to serve the purpose that you formulated in your question compared with just the ambition of taxing economic rents. The cash flow tax does it, but does it in an eminently practical way, and in that case there would be less concern with the level of taxation, since this tax is intrinsically neutral by design.
Roberta, Vitor is putting the eye on what could be solutions for longer term, but what is clear is that taxing cross-border activities of multinationals is still a big issue for the global agenda. So what would be your views and what should be your recommendations for the EU considering the current context?
Thank you, Susana. Well, I think I already pointed out what I think is a priority, right? Try to focus on the EU agenda and try to focus on simplification, decarbonization. It was very clearly mentioned by the Commissioner. We have this in front of us. So what should we do? I said that PR2 is a strong limit. It is a limit now for tax incentives, for government's ability to give tax incentives, because only those incentives that are monetized, that are cash back, that are paid back to the taxpayer, have a better treatment. It doesn't matter if the incentive is for innovation, decarbonization, or whatever. The only thing that matters if it is paid back. And now countries, we have also listened to this the whole day, we have strong financial needs, we have need to finance defense, security, and many other things, and don't have money to pay the incentives back. The Clean Industrial Deal recommends incentives and focuses on accelerated depreciation. Probably it's because this one is not that much penalized by PR2, but accelerated depreciation is an incentive, but we can be more ambitious, because accelerated depreciation is just a postponement of the taxes to be paid in the future. Also, the substance-based carve-out is not favorable for innovative business that we want to promote, because it focuses only on salaries and assets. And within the EU, we have the whole simplification agenda that was mentioned before by the Director General, by Gerasimus, so ATAT. Some of the rules are not necessary now with Pillar 2. BFIT could be a good idea, but as it is designed, it's another layer of complexity because it departs from Pillar 2. So if we want to have BFIT as a simplification, it should be fully aligned with Pillar 2. And then, of course, it's this about fragmentation. Here, probably the problem is that not all the things to be done we have the legal basis to do it. In the EU, it's not only the question about the unanimity, but also the legal basis. But there are things that can be done through recommendations. Of course, member states can do whatever, but the EU can take the lead recommending. Or even we have had code of conducts that have worked quite well, and this is an instrument that could work. And if I have one more minute, also, I think there is some frustration now on this international cooperation. For sure, the Global South, we have seen that, the work at the United Nations, because they think they haven't been heard at the work of the inclusive framework, even when they were there. But I think also at the EU, because at the end, out of the 140 countries that committed to the pillars, only 40, 2 years later, have implemented the rules. But the EU is practically the only geographical area that has implemented the whole set of rules. We plus 4 more are the only ones that have adopted the UTPR. And the UTPR is really challenging if we are supposed to apply the UTPR to US or Chinese or whatever multinationals. It's very, very challenging from an economic and legal point of view. And I know it's 40 countries, but it remains to be seen how many of those 40 countries are going to keep the rules if they are not implemented globally. So we have to be realistic. We have to be pragmatic. It makes sense to have this limit to tax competition between countries, but at the same time we have to recognize the situation and be realistic and modify, go through qualification of regimes, go to white list, modify the tax benefits, or introduce some kind of modification so we can keep the rules.
Tommaso. All the discussion about taxing multinationals in a very digitalized economy, on Pillar 2, this discussion of the substance carve-out and UTPR, should we be realistic or should we be more ambitious because it's not delivering enough?
So I agree with Roberta that we should, as much as possible, make life easy for businesses in terms of compliance with Pillar 2. The OECD can do its best work to make, to create safe harbors, to find ways to really simplify the mechanism to implement Pillar 2. Also because Pillar 2, as she said, it is only so far being picked up by OECD countries plus a number of G20 countries, but the vast majority of countries in the world have not yet introduced it. And they might struggle with capacity in terms of actually administer the rules. I think it's worth thinking already of what has Pillar 2 actually achieved, because Pillar 2 has not resulted in a reallocation of taxing rights. It's basically crystallized the rights of countries to collect taxes on the multinational operating within their border. And that means that, for example, for US multinationals, their profits that are sitting in tax havens in Europe will still be taxed by those same tax havens in Europe. They're not going to be reallocated back to the US. So we know some multinational, particularly digital multinationals, reallocated profits, intangibles back to the US and the associated profits, but a number of multinationals kept the same structures that there before. So one key thing that we're not done is reallocating taxing rights, and Pillar 1 was an attempt to reallocating taxing rights. And why is this important? If I go back in history, and I know Vitor likes when we look at historical anecdotes, in 1923, the Four Economists report to the League of Nations said that basically when you pick up oranges in California, they go zero value. They only really get value not when they're transported to another country, but actually when they're bought by the customer of that country. And only at that point they create value. And between those in the supply chain, we need to think who has the right to collect taxes on those profits. And what is clear now is that there is a move to a destination taxation. And as Vitor mentioned, destination cash flow tax is something that is being considered. it'd be interesting to understand if EU being an exporter economy, whether that works for the EU, but there was talks in the US a few years ago implemented this initiative, gas flow. But the issue is we need to find ways to, for those multinational, particularly digital, pharmaceutical multinational, to pay more, book more profits and pay more taxes in the countries where the consumers are. It is crazy that pharmaceutical multinationals, US pharmaceutical multinational, book more profits outside of the US than into the US, and they pay more profits, book more profits and pay more taxes outside the US than into the US, when most of the AP was developed in that country. How do we do this? One thing is to look at the first protocol of the UN Framework Convention, which is taxation cross-border services, building on both Pillar 1, but also what Liselott said around what the work done on the UN Tax Committee on simplified measures. That can work not just for countries like the EU, the US, but also for low-income, middle-income countries with slightly less capacity to implement these rules.
Thanks, Tommaso. And again, the view from the global south and interconnection also with the different approaches, especially at the UN.
Thank you, Susana. Well, I think all day, I think one of the big lessons is that we do need to work internationally. Even if you're a single market, that single market needs to work internationally with other markets in the world. And So how should we go about that? Well, the best way perhaps is to look a little bit at what has been done and what coordination efforts have not worked as well as we perhaps all hoped for. And I'm referring to the inclusive framework. I think the inclusive framework is the best thing and the best idea that the G20 and the OECD could come up with. I think when you listen to the developing countries that took part in that, they ended up not being very happy. And why was that? Many of them thought that they had been invited, but they were only sitting at the table with a fixed agenda that they hadn't decided on, and they were unhappy with the agenda, and they wanted to talk about things that were perhaps more important for them. They also thought that there was going to be a consensus-based decision-making process, and some of them at least are not in agreement that decisions that were taken by the inclusive framework made on a consensus basis. Now, in short, I think one needs to think out of the box. I think when you look at systems, they need to work in an international framework. My own country, I come from Chile. I'm a Chilean tax official. About 35 years ago, we had a corporate tax that actually was not levied as long as you didn't distribute the money. So the idea behind it was actually to just make reinvestment, because there was no cost at all. It was zero. Now, of course, no one remitted anything, so the poor government was without any funds at all. So then we got the 10%, and now finally we are up in the 25%. But the structure of it is the same, is that you get the full credit when you do distribute. So you get a sort of prepayment, first of all, on your profits, and then when you distribute to the owners, you get the credit for that. So we don't have actually double economic taxation in our country. Now, in short, coming back to what is the international corporations, I think one needs to be open to set the agenda together. An inclusive dialogue, ensuring that transitions between different economies, small, large, and this I think is really important, because I've been listening as well yesterday on the dinosaurs, etc. There's small dinosaurs, there are big dinosaurs, there are aggressive dinosaurs, and enough of that. The thing is, even within the EU, the economies are different. And the world is different. The South, my part of the world, South America, GRULAC, which is our area within the UN, we are Caribbean and Latin American. And, there's a big difference between Brazil and Barbados. And so, you know, within the grouping even, the differences are huge. And we need to, you know, take care of that, because everyone needs to be on board. No country needs to feel marginalized. So one needs to strive for consensus-based solutions, but if it's not achievable, I think you have to be, you know, you have to be honest as well that it might not be possible with all these type of economies. So if you don't find a consensus, you will have to find within the negotiation like-minded countries, and then, you know, hopefully this like-minded group is as large as possible so that you actually get something useful internationally. You know, within the UN, to talk a bit about the decision-making process, the UN, the General Assembly rules are majority, simple majority. And this has been something that we've been discussing a lot the last year, because there was, especially actually from EU countries, some EU countries, that wanted a consensus-based decision-making process at the UN. And of course, that is what you should strive for, but I think it's, you know, it's impossible. And I think I heard someone at this panel earlier as well talking about, you know, you even within the EU might want to rethink about the consensus decision-making process. Now, of course, this cooperation, what I'm saying is that it could take part anywhere. It could be the UN, the FTA, the Foreign Tax Administration, under the auspices of the OECD. My country is a member of the OECD, and we're very happy members. We do a lot of work with the OECD, but we also take part as a small economy in the United Nations work, and I think that is something that for us is very important. We take part in any international cooperation that we could take part in to make a better, prosperous world. Thank you.
Thanks, Liselott. How difficult it is to take care of the difference to deliver a real and transformative agenda, and building on that, how difficult it is to get consensus. With that, we're going to move to some questions from the audience. I have first seat number 247. Is Ruiz Afonso. Oh, thank you. Just in conscious of time, you can make short 1 minute contribution so we can have time to discuss and to respond.
First of all, I would like to congratulate the entire panel for the excellent debate on such an important topic for the future of the European Union. If the US withdraw the international agreement on a minimum corporate income tax rate of 15% to be paid by multinational companies, many questions will arise about how the European Union will respond. So I ask you, what countermeasures the EU can implement to prevent the European companies from being harmed in terms of trade, since the US tax could make US multinationals more attractive? The European Union could seek stricter enforcement by applying a global minimum corporate tax, or even by adjusting its own tax rates to avoid distortions. And what are the consequences of this choice for the international business market and internal tax policy in the EU? The measure could put greater pressure on EU countries to reform their own tax policies, as well as aggravate international negotiations on taxation. This is my question. Thank you.
Thank you very much for being sharp. I have now a question from seat 108 from Paris Kokopolopoulos. No, well, sorry for your destroying your name.
Thank you very much, Madam Chair. If you ask citizens in any part of the world, they will say that Pillar 1 is the very best. And yet, we've heard some strong arguments from the panel explaining how difficult it is to actually implement Pillar 1. So what is the European Union doing? We cannot impose Pillar 1 on our own, but I believe that we have to find a way to speed up the process, because we recently heard the President of the European Commission make a statement and talk about the need for defense expenditure and talk about the well-known problem of the 800 billion euro that we need. And there is a very serious worry that cohesion funds are going to be reallocated to defense. These aren't straightforward decisions. So we need additional resources on a sound basis that will be used for this. So I really think we need to speed up what we're doing.
Thank you. And now I have questions from seat 291 from Ville Vahamak.
Kiitoksia, hyvä puheenjohtaja.
Thank you very much. When developing policy, we need to take away from the administrative burden from corporations. However, we need more fairness. Are these two objectives opposite to each other? I believe not. I believe that the European Union needs to be active with the OECD. We need to have a clear framework, and we need to have a lighter administrative burden. Changes need to be predictable for companies in the long run. We need to have more stringent gold plating. We can't have gold plating as this is uncompetitive. We need to respect local decision making and sovereignty. We need to have common rules that are made in an intelligent manner. I would like to ask, how is it possible to have a smaller administrative burden, and through this, more intelligent rules in the European Union? Thank you.
Let's go through this round of questions, which are quite complementary and similar. Roberta, do you want to go first?
Sure, thank you, Susana. Maybe we start with the first one, right? What do we do if in the US finally PR2 is not going to be adopted, implemented? Well, we have the answer in the rules on PR2. We have the UTPR, that is the closing rule. What is the problem? The problem is that UTPR, it's really difficult to apply. Imagine we have an American group with only one subsidiary in the EU, American or Chinese or whatever. This subsidiary will have to pay to its tax administration in Belgium, Spain or whatever, any remaining tax up to the 15% that hasn't been paid in the US. Do we think that this is really going to work in practice? This subsidiary will have to close the doors the next day, will go bankruptcy. So it's the rules as they are designed, the UTPR is quite tough. The problem is that the rules don't work without the UTPR because it is the closing rule of the PR2. What probably could be a solution to go through a system of wide list of jurisdictions? We have always operated in international tax with list of jurisdictions. Just analyze the regime of a jurisdiction. If it is okay, then include it in a wide list. But it doesn't have to be to follow exactly PR2. What we are looking for is low tax countries. But those countries that are not low tax, but sometimes may approve incentives, as the ones we are saying in Europe that we are going to adopt, those are not low tax countries. So I think probably the way could be to move to a system of wide list. And by the way, like that, we remove all the burden on the companies and the tax administrations. On Pillar 1 is not to obtain more revenues. Pillar 1 is to relocate the revenues, and probably in Europe, European multinationals will be having to pay part of the tax bases outside of the EU. So I don't think that's the solution for our problems of getting more revenues. And was there something else? Or maybe
maybe we can take Tommaso now and build from what Roberta was saying, and maybe this idea of the complementarity between the sovereignty and the need to have coordination.
Yeah, just briefly. It's important to note that the US actually has not just but one minimum tax, but two minimum taxes, and it was the first country that introduced a minimum tax in the first Trump's tax reform. So where does the problem lie? The problem lies in the fact that those two minimum taxes are not exactly the same as the OECD Inclusive Framework Pillar 2. So it is possible, for example, that a US multinational, pharmaceutical, let's say, that has a manufacturing facility in Puerto Rico, if Puerto Rico does introduce a minimum tax, then those profits will still be potentially taxed at 0% or a very low rate. That is a problem of competition for European multinationals or even Irish subsidiaries, entities, or multinationals that now actually are paying tax and will be paying tax at the minimum, 15%. So Roberta is right that this is potentially very complex, but at the same time, we can't let free riders and multinationals still being able to pay zero tax or close to zero tax in some countries. So what needs doing is trying to reconcile this dilemma and making sure that we, on one hand, ensure that the minimum tax is applied by all countries in the world and reduce the compliance burden for multinationals.
Vitor.
Okay, so I will go from end to beginning. Is there a contradiction between lowering the administrative burden and improving fairness? No, on the contrary. The more complex the tax system is, the more the high net worth individual are able to game the system in their benefit, and if you cannot afford a tax lawyer, you're disadvantaged. The simpler and more transparent the system is, the more it offers a level playing field, and then the progressivity that you have in the law is actually effective progressivity. That's why most economists believe that having a tax system with relatively low tax rates and broad bases is not only more efficient, it's also fairer. So that was the easy one. I believe that the question on Pillar 1 has already been answered, so I will not go for that one. Let me spend a little bit of time on the US and Pillar 2. So one aspect that I believe is very important to recognize is that a relatively large number of countries, about 50, mostly advanced economies, have adopted Pillar 2. That basically means that the incentive mechanism associated with Pillar 2 is in force, and if countries keep the course, there is no way back. Now, I think it's worthwhile to elaborate slightly on what Tommaso has said, because it's actually quite important. The framework that eventually led to Pillar 2 agreement came from the US, and it came from the Trump administration. It comes from, Tommaso quoted it but did not name it, the Tax Cuts and Jobs Act. And the Tax Cuts and Jobs Act had two innovative features, the guilty and the bid, and they're basically anticipating what eventually became Pillar 2. But it's very important to understand that as they stand now, they're not fully compatible with Pillar 2. That Tommaso has said, I believe I'm saying it louder. Am I? Now, one aspect which is also important to understand is that formally, the US had not adopted Pillar 2 yet, and so the OECD framework had been agreed but had not been adopted in the US, and the opposition to Pillar 2 had been a traditional Republican stand in Congress for quite a while. So the presidential executive order as such has not, in fact, changed the US position much. It sounds fundamentally different, but the legal consequences stay more or less unchanged.
Thanks. The US is the elephant in the room, Liselott.
I don't think I have very much to add, actually. No, I think, you know, it's of course, as people perhaps know, the US left the UN Framework Convention negotiation and stated that they were not going to take part. And one of the questions there was, is this, you know, what does that mean? Well, a personal point is that I always think that you have a good solution if you have different views on how to reach a solution. So therefore, it's, you know, it would have been very good to have the US in the negotiating table because they could have had, you know, a different view. They haven't supported the view that the UN tax should be a tax framework. So having a sort of negative voice in the negotiation would have been good, I think. However, there are others who says, look, you know, they were never going to be on board anyway. So, you know, let's work with the rest of the world and try to reach something that could be useful. And then, you know, not everyone has to be on board always. So let's see how it goes.
Yes, don't give up. Now I'm turning to seat 79, Gabriel Zuckman. Gabriel.
Thank you very much. I'm going to ask again what is probably the most important question, and let me try to ask it in a more forceful manner. Pillar 2 is the most important international economic agreement of the last decades. The crown jewel is the UTPR. Why? Because it gives incentives to the different countries to join the agreement, and it ensures that if some countries don't, then their multinationals will still be subject to the 15% minimum tax. It's a groundbreaking idea and provision which can stop the race to the bottom and ensure finally some degree of tax coordination. It is under attack by the Trump administration. My question for the panel is, are you willing to fight to defend it? Thank you.
Well, I think we need another 2 hours to respond to that. Seat 282.
Raymond Luya from Maastricht University. I agree with the previous intervener that Pillar 2 is very important. It's a time of multilateralism. We have need for collective action. We've talked about Pillar 1, the possibilities of a destination cash flow tax. We're about taxing high net worth individuals. We have Pillar 2. The problem is we're now in this collective idea. But we still have to deal with existing bilateral tax treaties, which even question whether the UDPR we can keep it up. We've just adopted it in 40 countries, but it's still to be tested in courts whether this will hold at all. So my question is, going forward in a collective environment, should the EU take a role when it comes to the current status or renegotiation of bilateral tax treaties to make those things actually possible? I'd love to hear the panel's position on that. Thank you.
Thank you. Not very easy questions today. Seat 446, Mona Baraka. Lovely to see you.
Thank you, Susana. I worked a lot on Pillar 1 and Pillar 2, and it's a very simple question. So, as you know, the US, at least before, preferred a bit Pillar 1 because it's a cooperative measure as opposed to the digital service taxes. But with Pillar 1 kind of dying now, do you think that countries are going to use the STs again, or it's also going to be a dead-end road? Thank you.
Thanks. Well, who wants to go first? Tommaso?
Go on then.
So we have 10 minutes to finalize the panel and make all the big questions of today.
Okay. I think it's important. We talk about some of the the threats that Trump made through the executive orders and memorandum in early January, February. But more recently, Trump sat down with the Irish Prime Minister, and he said something that was quite interesting. I quote because it's worth listening to. So Ireland took our pharmaceutical companies, tremendous job, through taxation, made it really good for them. The European Union treat us very badly. European Union was tough, and it's our turn to be tough. Sue our companies and they win a huge amount of money. I'm not knocking them down. They did what they had to do, but that's create ill will. So to answer Gabriel's question, I think the European Union needs to do what they have to do, which is to protect the integrity of the single market. They have to protect the competitiveness of its multinationals. So in this tit-for-tat trade negotiation with the US, they need to be careful about giving up measures they think are very important to keep the two-pillar solution or the pillar two, the minimum tax, together.
Thanks. Vitor, do you want to go
on? Of course. Gabriel, I believe I completely agree with your description of the incentive mechanism associated with Pillar 2, and I agree with your assessment that the fact that it is incentive compatible makes it self-sustaining, and that's what I tried to indicate when I said that given the adoption of Pillar 2 by so many countries, one can regard the process with some degree of irreversibility. On the importance of multilateral cooperation on tax, I think that inside this panel and inside this room, you will get the broadest possible consensus on the need to preserve multilateralism and on the value of multilateralism. Here in the European Union, we're probably in the best place on earth to make that point. So I believe that this time around, I agree with you 100%. I believe that the issue of Pillar 1 has been answered apart from the issue of digital services taxes imposed unilaterally. So here again, the favored solution is multilateral and cooperative. We do see that there are dangers associated with unilateral taking of positions. I must confess that on the question on legal uncertainty associated with bilateral and multilateral rules, I don't know the answer, but if you're interested, please drop me an email and we will reply to you in writing. Thank you.
Liselott, is that a question?
Just sort of coming back to the DSTs, I think the DSTs, are they an excise tax? Are they an indirect tax? Are they any income tax? It seems to me a little bit vague. And I think perhaps one way forward it could be to sign up to Article 12b of the UN tax model, which actually allows cross-border withholding on payments on digital services, and then you get the credit on the other side. So it's basically an option there, and but you do have to recognize that it's an income tax then.
Thanks. Roberta, final word for you. Because it's coming all the time also about the fragmentation.
Very fast. Thank you, Susana. On the UTPR, it hasn't been adopted by 40 countries. So we have 140 inclusive framework, 40 more or less, a bit more, PR2. UTPR is 27 plus a couple less, because the UK hasn't adopted the UTPR, Switzerland hasn't adopted the UTPR. Of course, so these countries that have been adopting PR2, like Hong Kong, Emirates or whatever, they don't adopt the UTPR. So it's really Europe. the one that has adopted the UTPR. I agree that the PR2 without the UTPR doesn't work, because at the end it's difficult to solve it. But at the same time, UTPR is being challenged at the core, because there is a important discussion within the nexus, within the economic capacity. In the example I tried to give, if there is only one subsidiary in the EU, this subsidiary will have to pay all the taxes of the whole group. What is the property, economic capacity, so many things, many challenges, economic and legal. So we have to work on this, because it's a problem only for Europe with retaliatory measures. But apart from that, because I think we have to maintain the rules if we believe strongly in the rules, is that they are very, very complex and very challenging, the UTPR, legally and economically.
Thanks, Roberta. So without the UTPR, the Pillar 2, the minimum tax, was supposed to be the big step forward. It's not working. With is complicated. And especially for the European Union, who's more than any other region in the radar of the US, with those retaliation measures that have been announced by President Trump on his first day in the White House. So I think there was one simple principle that was important on corporate taxation, is that it really needs global and multilateral solutions. But even that principle is at risk at this moment. The European Union cannot afford not to be engaging into this direction of international tax cooperation, and cannot wait only for the US to take the lead on what's going to be the future of international and corporate taxation, because that will affect fairness, and that will have a huge impact on inequality, and that's extremely linked also to the discussion this morning on taxing high net wealth individuals, because behind those very big corporations, we have very rich individuals who are taking advantage of the lack of measures that are being implemented. So fairness at the heart of decisions, multilateral principles to be protected, and a big agenda for the European Union that is in front of a challenging year. So with that, big round of applause to this panel that has been responding to tough questions today. Thank you.
Thank you all very much for sharing all these points and giving us more food for thought. So we're now going to break for coffee, and you can stretch your legs. We are back here at 4:20, please. Thank you very much.